Hello and welcome back to my money lessons. I am Dr. Charity of Wealthy Gen. Let's talk capital gains. If you do not like the idea of buying an asset and holding it for a long time, you just want to sell it at a price greater than you paid for it and make some profit, then you are investing for capital gains. Is investing for capital gains right for you? Find out in this income series number 5. My goal with this lesson is that at the end, you are able to make that decision if investing for capital gains is right for you. I will also offer some tips to help you make that decision. But first, what is capital gains? So you receive capital gains when you sell a capital asset you own at a price greater than you paid for it. So the difference between the price you paid to acquire the asset and the price you sold it for is your capital gains. So capital gains is applicable to any capital capital asset, stocks, funds, and gold, silver, platinum, real estate, automobiles, and machineries. So it's not restricted to only stocks and funds as most people would think. As long as it's a capital asset, it has potential for you to receive capital gains once you sell it at a price greater than you paid for it. So is investing for capital gains right for you? Here are a few things you need to keep in mind or consider as you make that decision. First is that capital gain is not realized until the asset is sold. So in order for you to receive capital gains, you must sell the asset at a price greater than you pay for it. That is when you receive capital gains. So at this point, let me explain the two investment principles you should keep in mind. First is investing for cash flow. So if you're investing for cash flow, you get to keep the asset and you still get paid. So it's like you're keeping the hen and then you keep receiving the eggs, right? So investing for cash flow, you keep the asset and then you get paid. An example is when you buy shares of a company that pays dividend. So every time the company declares dividend, you get paid while you still own the stock. So you do not have to sell the stocks to get paid dividend. You still own your stock and then you get paid. I have a lesson on dividend income. If you tap on the description box, you will see the link to that dividend income lesson. So if you're interested in reading about the dividend income and how you can make the best of it, click on that link and watch the dividend income. So that is an example of cash flow investing. Another example is someone that is interested in investing in real estate and they buy a property. So instead of selling the house, they still keep the house, but they put the house out for rental. So every month they receive rental income. So the rental income is the cash flow they receive. So they do not have to sell the house, but they receive income every month once they get paid. So the other strategy or the other principle is capital gains, investing for capital gain, which is what we are discussing today. So investing for capital gains means you sell the asset and then you get paid. So you have to sell the asset at a price greater than you paid for it. If you sell it at the price below, less than you pay for it, you have capital loss. So to get capital gain, you sell the asset at a price greater than you pay for it. An example is, let's use the stock as an example. When you buy shares of a company, you must sell that share at the price greater than you paid for it. Then the difference is your capital gains. The housing example, someone that bought a house, you must first of all sell the house, and then the difference between the cost price and the sale price is your capital gains. So back to what we are discussing, capital gain, it is not realized until the asset is sold. So it's like losing the hen for you to get the egg, right? Here is like you're keeping the hen and then you're getting paid on the cash flow, but here you're losing the hen for you to get the egg. So the other point for you to consider is the tax implications. So investing for capital gains has tax implications depending on what part of the world you live in and depending on the tax policy applicable to where you live in. So generally, they are taxed depending on whether it's a long-term capital gain or short-term capital gain. So when you hold your asset for longer than 1 year, and before you sell it, so the capital gains you received is considered long-term capital gains. However, someone that's held the assets for lower than 1 year, if you sell it within 6 months, 5 months, as long as it's not up to 1 year, it's considered short-term capital gains. And mostly short-term capital gains are taxed at a higher rate than longer-term capital gain. So keep that in mind as you make that decision. So before you sell your asset, consider the tax implications. to see if it's the right thing for you. So the other point is that investing for capital gains has the potential for higher returns. So unlike the investing for cash flow, investing for capital gains has that potential for higher returns. I'll give an example. Someone that purchased 1,000 shares at $10 per share and sold it at $15 per share, we receive capital gains of $5,000 because the cost of purchase is $10,000 and the total income from sales is $15,000. The difference is $5,000. So it is very possible for someone to receive capital gains within one day, within 1 month, within months, as the case may be, or even within years, depending on how the market moves. So market can be favorable to them, prices will swing up. And if you are a capital gain investor, you can just sell your assets and cash in on the gains. However, there are two sides to every situation, and we all know our risk and return relationship. Investments that have higher returns also have higher risk. So there's potential for higher risk with investing for capital gains. So as the market is swinging up for you to give you the opportunity to cash in on these gains, it can also swing down and you have the potential of losing a lot of money. So put that in mind as you're considering investing for capital gains. So you have the potential of gaining a lot and you also have the potential of losing a lot. So here are a few recommendations to keep in mind as you make that decision. One is understand the market and the asset. By this, I mean do your homework. Research more than you invest, right? So the idea of researching the market and the asset is, first of all, if you want to invest in any asset, what market, what industry does it operate? Someone that wants to invest in real estate, first of all, research and understand the real estate market. What moves the market? What makes the market move up and down? Any new laws, any new trends? Learn everything you need to learn about the industry. And then after you understand the industry, drill down to the asset itself. What is that asset that you want to buy? How does the asset move? What is the intrinsic value of that asset? What is the true value of that asset? Someone that wants to buy real estate, understand the neighborhood. What is going on in the neighborhood? Is there any new development? What's the trend? What is happening? You have to understand the market and the product that you're trying to invest in. Then after you make that assessment, buy the asset when the asset is undervalued, not when everybody else is buying. This is very important. Okay, so because when everybody is buying, it could be that the price is already high. Because remember the law of demand and supply, when there is higher demand, prices tend to push up. So your goal is to buy when the asset is undervalued. And for you to do that, that means you must have done your research on the asset to determine its true value. Then you compare that with the current market price, right? So your goal is that the current market price will fall below its true value. That is when you buy, and that is when you have the higher potential of making higher capital gains. I'll give you an example. If an item is truly worth $10 and the current price is $5, this is the right time for you to buy, because even if it eventually recovers to its true value, you are already making $5 capital gains when you sell it. So your goal is to research the asset to know its true value and then buy when the asset is underpriced. So sell when the asset is no longer overpriced, not just because the market is down. This is important because markets can be down just for a temporary, a short period of time. It could be just reacting to maybe one news or something. Don't just sell because the market is down. It can recover within seconds. It can recover tomorrow. It can recover next. But your goal is, because you've done your research, you know why you are buying this asset. You sell when it's no longer meeting that goal, that reason why you bought it in the first place. That is the right time for you to sell. And you know when item is no longer overpriced, the next thing is to start falling. So at that point that the item is no longer overpriced, that is the point when you sell. So the other point is for you to be clear on your investment principle. You have to determine, you have to know which investment principle is right for you. Are you more investing for cash flow or investing for capital gains? You have to keep that in mind and determine which one is right for you. So when you keep that in mind, it's gonna inform your decisions. It's gonna inform your action. So know which investment strategy works for you. That doesn't mean you can do a little bit of the other. You can still do a little bit of the other, but you know your principle. Your principles will guide your decisions and actions. Have a steady cash flow or emergency fund. This is very important because when you are investing for capital gains, you need to sell when the price is higher than you paid for it. That is when you get capital gains. But if you do not have a steady cash flow or emergency fund, things may happen and you will need to have some fund immediately. If you do not have steady cash flow or emergency fund, you might be tempted to liquidate your investment or sell your asset before the price is right. So have a steady cash flow so that you're able to hold your investment up until the time the price is right for you to sell and cash in on your capital gains. So at this point, I want to say thank you for listening. And if you tap on the description box, you will see the link to the dividend income lesson that we talked about. Go ahead and enjoy it, and I'll see you in my next lesson.